Picture this. You wake up tomorrow and every headline screams the same word: crash. Stock indexes spiraling, real estate listings piling up like unsold Christmas trees in February, and the talking heads on TV whispering the word depression, with the unease of doctors hiding a grim diagnosis. Now, before you clutch your chest and reach for a paper bag, hear me out, because I've watched this movie before, and every single time the credits roll, a small circle of prepared investors walk out of the theater unimaginably richer. When I was a 28-year-old nobody, inflation in my country hit double digits. Mortgage rates flirted with 18%, and everyone older than me swore the world was ending. I didn't buy their panic. I bought 3 small apartment buildings instead. 100% financed with debt, everyone else was too terrified to touch. 2 recessions later, those buildings alone pay for my grandchildren's college tuition in cash. You see, crisis is just the market holding a clearance sale for anyone brave enough to walk through the door. Think about the numbers today. Global debt has exploded past $300 trillion, roughly 330% of world GDP. That's like earning $100 and owing $330. Unsustainable? Absolutely. Inevitable crash? Of course. But here's the twist that keeps me smiling. Every bubble that bursts also deflates the price of real assets: land, productive businesses, barrels of oil, ounces of silver, down to everything must go levels. And that, my friend, is when fortunes are minted at lightning speed. So when you hear that the S&P just erased 5 years of gains in 5 ugly trading sessions, I want you to ask yourself one question. Am I the frightened seller, or am I the calm shopper with an empty cart and a pocket full of dry powder? Takeaway: crashes are the universe's way of transferring wealth from the panicked to the patient. If you master your emotions now, you'll dine on assets the way a lion feasts after the stampede has passed. The last time global debt crossed $100 trillion, I was in my early 40s and buying distressed shopping centers for the price of their parking lots. Today, it's triple that. $300 trillion and ballooning faster than a late-night infomercial mattress. Governments gorge on cheap credit. Companies roll over junk bonds like a drunk at a roulette table. And families finance vacations they can't remember with money they haven't earned. How does that end? Exactly the way every debt binge ends. A collective hangover so brutal it wipes the smile off even the most optimistic banker. Look at the canary in the coal mine, the bond market. Over 40% of sovereign bonds worldwide now yield less than inflation. Translation: you lend $1, you're handed back 97 cents in purchasing power a year later and told to clap for the privilege. Is it any wonder pension funds are wobbling? Your teacher's retirement check, your uncle's union pension, the nest egg your parents spent decades building, every one of them leans on bonds that are quietly bleeding value. That's the silent crisis no politician dares to spell out on televised debates. But here's the silver lining. No mainstream outlet will trump it. When the safe assets crumble, real assets, scarce land, energy, productive businesses, flip from expensive to bargain bin overnight. And that is exactly when disciplined capital steps in and writes its own fairy tale. Pause for a moment. Imagine standing in front of a skyscraper whose developer defaulted because floating rate debt doubled his monthly payments. The building is 68% occupied, cash flow positive, and the bank is desperate. How much of your money do you really need to place on the table if you can negotiate a creative financing package the way I did in '94, '01, and '09? I'll give you the answer. Far less than the talking head gurus on breakfast TV claim. This is why debt, when used strategically, is not a liability but a lever, one that multiplies returns instead of stress. Now, before we march into tactics, let's sharpen your mindset. If you find yourself rooting for the market to go back up, you're playing the game backward. Seasoned investors cheer for volatility the way surfers chase bigger waves. Why? Because the ride is impossible without them. Ask yourself, will I be the terrified seller dumping my future to feel safe? Or will I be the poised hunter buying fear itself at a discount? Ready to turn chaos into a springboard? Good. Because next, we break down the three-bucket system I use to ride out any storm while stacking cash-flowing assets like dominoes. First, the panic-proof bucket. This is the cash you tuck away where no algorithmic trader can vaporize it at 3 a.m. GMT. I keep 12 months of living expenses parked in short-term treasury bills and physical silver coins. Nothing fancy, nothing that yields six-figure returns on Instagram screenshots. Why so much dry powder? Because history shows that the average bear market bottoms out roughly 14 months after the first 20% drop. Picture March 2009. The headline screamed, "End of capitalism." Yet the banks were willing to unload apartment blocks for half of yesterday's appraisal, if you could close in 7 days. My panic-proof stash let me swoop in with the certainty of a surgeon. Everyone else was still filling out SBA relief forms. Next, the cash flow bucket, the muscular core of the portfolio. This is where I place assets that pay me whether the market is high, low, or sideways. Multifamily real estate in cities with net inbound migration, energy royalties that drip dollars every month, and equity slices of boring businesses everyone else ignores. Remember the 2020 lockdowns? My chain of coin laundries kept spinning quarters while luxury retailers boarded up windows. When the economy gasps, cash flow is oxygen. Collect enough, and you can breathe comfortably while others suffocate on paper losses. Finally, the moonshot bucket. 5 to 10%, never more, allocated to asymmetric bets that can 10x without blowing up the plan if they go to zero. For me, that's early-stage geothermal startups, next-gen battery metals, selectively, Bitcoin mined with surplus hydropower. Notice I said selectively. I'm not the guy screaming all in on Twitter Spaces at midnight. I'm the quiet billionaire who buys the panic dump of quality tokens after an exchange implodes, then sits silently while they claw back to new highs. Now here's the discipline. Money graduates from one bucket to the next only after strict criteria are met. When the panic-proof bucket is topped up, the overflow feeds cash flow. When cash flow throws off an annualized 12% or more after debt service, the excess is permitted a one-way ticket to moonshot. No reverse commuting, speculative wins never leak back into living expenses. That wall keeps lifestyle creep from sabotaging the empire. Let me illustrate. During the 2022 crypto winter, I harvested a 7-figure gain from a lithium royalty deal. Instead of upgrading my yacht, I moved the profit straight back into Class B shares of a tax-delinquent storage facility portfolio. That single decision now pays the annual operating costs of the foundation that bears my granddaughter's name. See the pattern? Assets, not toys. Buy freedom. Then freedom lets you pick up toys with the interest if you still care. So as you watch the headlines devolve into financial horror fiction, ask yourself, which bucket is empty? Which one is overflowing? And do you have the courage to move capital across that invisible one-way bridge at precisely the moment fear peaks? Picture the scene. A bank's marble lobby echoing with silence because the branch just froze new lending. I'm sitting across from the workout officer, a man who looks like he hasn't slept since the Fed's last emergency meeting. On his desk lies the file for a downtown office tower, loan in default, owner underwater, tenants still paying. I offer him one thing he can brag about at tomorrow's crisis meeting: certainty of close. 90 minutes later, I walk out with control of a $60 million asset for a 5% downstroke and a clause that lets me refinance without penalty when rates normalize. That single deal now spits out more free cash each quarter than my first 10 years of salary combined. Why am I telling you this? Because the same kind of once-in-a-generation mispricings are stalking the streets right now, disguised as bad news. The talking heads will screech, "Commercial real estate apocalypse," but they won't mention the occupancy-adjusted cap rate that's quietly crossed double digits in Tier 2 cities with growing tech hubs. They'll moan about student loan delinquencies, Yet ignore the fact that purpose-built student housing keeps posting 97% collections, even in recessions, because kids still want diplomas when jobs disappear. So here's the 4-step RAID plan I teach my protégés. Map the distress pipeline. Track CMBS delinquency reports, foreclosure filings, and corporate bond downgrades. When the pipeline bulges, opportunity overflows a few months later. Sharpen your valuation sword. Know exactly what a stabilized asset is worth, the way a butcher knows the weight of a steak. If you can't underwrite income and expenses on a legal pad, you have no business negotiating. Enter with control, not ownership. Master lease with purchase option, seller carry, assumable debt. These are tools to lock the door before competitors see the "for sale" sign. Force equity fast. Raise rents to market, slash bloated service contracts. Restripe the parking lot. Add paid storage lockers. Then refinance and recycle the capital into the next distressed gem. Miss one step and the shark bites back. Execute all 4 and you'll print cash while everyone else tweets doom scroll memes. But let's address the whisper in your head. What if the crash lasts longer than my runway? Good. Healthy paranoia keeps fortunes intact. That's why my next move is always buying time. Lengthen fixed-rate debt maturities, preload maintenance reserves, secure interest rate caps even when they feel overpriced. Never forget, the market can stay irrational longer than amateurs can stay solvent. Now, tuck this gem away for cocktail parties. During the 1973 oil crisis, global GDP growth collapsed to 1.6%, but oil majors that locked in sub-$3 drilling rights 2 years prior posted record profits by 1975. History's rhyme? Battery-grade nickel and copper today. I'm scooping royalties on deposits proven at $9,000 per metric ton, while demand curves scream $15,000 by decade's end. That's not speculation, it's arithmetic. Mid-video teaser. In a minute, I'll reveal the single negotiation phrase that saved me $42 million in interest payments. Tattoo it on your financial DNA, and lenders will chase you with better terms for life. But first, a reality check on risk. The 3 kill shots that take down. Overconfident investors. Overconcentration. 1 shiny tech stock, 1 downtown condo, 1 meme coin. Doesn't matter. When 80% of your net worth hangs on one hook, a single gust sinks the ship. Liquidity arrogance. Assuming you can sell when panic peaks is like assuming you can sprint through a burning theater faster than the crowd. Doors bottleneck, bids evaporate, and you're left holding smoke. Ego leverage. Debt can be a jet engine or a suicide vest. Strap it on without cash flow to cover interest. Boom. My rule. Fixed debt service must never exceed 65% of worst-case net operating income. Tattoo that next to the negotiation phrase I'm about to share. Ready? Here it is. What flexibility can you offer me if I solve your problem today? I've used that exact line with banks, landlords, even governments. It flips the psychology, positions you as rescuer, not supplicant, and pries open concessions you'd never see on a term sheet. Use it verbatim, then shut up. Silence makes the other side reveal their real pain points. Remember, markets punish the careless, but they lavish the prepared. The next headline panic could flash across your phone tomorrow morning. Will you swipe away the alert and go back to scrolling? Or will you step into the arena armed with buckets brimming, pipelines mapped, and a single question on your lips? What flexibility can you offer me if I solve your problem today? When I spot a crisis forming, I open what I call my dashboard of doom. 5 dials, updated weekly, tell me whether to step on the gas or slam the brakes. The yield curve spread. When 3-month treasuries pay more than 10-year notes, bankers stop lending and recessions follow like night after sunset. High-yield credit default swaps. The moment BBB corporate insurance spikes past 500 basis points, zombie companies turn to dust, and their factories, fleets, and patents trade for pennies. Baltic Dry Shipping Index. If global freight collapses 40% in 60 days, world trade is seizing up. Inventories pile sky high, and warehouses beg for fresh capital. Real M2 money supply. 2 consecutive quarterly drops mean liquidity is draining faster than politicians can promise bailouts. Consumer sentiment below 60. That's the zone where families cancel Disney cruises and unload second homes. Distressed sellers suddenly outnumber buyers 10 to 1. In October 2008, every dial on that dashboard flashed blood red. While TV anchors wept over Lehman Brothers, I wired a non-refundable deposit on a portfolio of foreclosed self-storage sites. Average purchase price, 38 cents on the original construction dollar. Within 4 years, stabilized rents tripled my cost basis. Today, those boxes of forgotten furniture fund scholarships for engineers searching the asteroid belt. Lesson: data isn't just numbers. It's night vision goggles in a smoke-filled room. Without it, your next move is guesswork. With it, you harvest panic the way a vintner picks grapes after the season's first frost. Sweet, concentrated, and profitable. But numbers alone don't mint fortunes. Behavior does. That's why every morning before markets open, I run the billionaire's boring checklist. Did I sleep at least 7 hours? Have I read something unrelated to finance to widen perspective? Is every major holding hedged or insured for tail risk? Have I scheduled one conversation with a smarter person and one with a total beginner, so hubris never gets the last word? Miss 2 boxes in a row and I freeze all new trades for 48 hours. Extreme? Maybe. But nothing ruins compounding like an impulsive click. Now, let's talk. Tax. Because the government is your silent partner whether you like it or not. In a crash, Washington's deficits balloon, and politicians scramble for stimulus. You can either shout at the televised hearings, or you can quietly align your capital with the incentives they just created. Bonus depreciation on energy-efficient upgrades? That just slashed my storage conversion payback to 18 months. Investment tax credit for solar rooftops? Every apartment complex I buy now comes with a mini power plant that trims tenant bills and fattens net operating income. Opportunity zone rollovers? Take the capital gain from liquidating a moonshot token, funnel it into a blighted downtown lot, and watch your tax bill evaporate like dew in the desert. Remember, wealth isn't what you earn, it's what you keep. The fastest way to double after-tax returns is to halve the money you forfeit to bureaucrats. Let's pull this together. Markets are lurching, politicians are printing, and social media is screaming apocalypse. Yet behind the noise lies the simplest roadmap I've ever followed. Read the dashboard. Protect the base. 12 months cash, silver in the safe. Buy the cash flow. Assets that pay rent, royalties, or dividends tomorrow morning. Add the rocket fuel. A measured slice of asymmetric bets. Keep more than you earn. Structure deals so Uncle Sam cheers when you compound. Everything else is commentary. Now ask yourself, which dial on your personal dashboard is blinking right now? Which box on your boring checklist went unchecked this morning? Drop your answer down below. I read every comment, and the best one gets a signed copy of my very first deal spreadsheet, coffee stains and all. So here's my closing thought. One that carried me from a one-bedroom rental to a life where compound interest works harder than I ever could. Crises don't steal wealth. They simply transfer it from the unprepared to the disciplined. The headlines may thunder about defaults, layoffs, and the end of an era, but history is kind to those who keep dry powder, buy cash flow, and refuse to let fear rent space in their heads. Tomorrow morning the market will open with zero memory of today's panic. Will your next move be driven by yesterday's fear, or by a decade-long vision only you can see? If this video armed you with even one idea that tightens your plan or calms your nerves, drop a comment below. Tell me which dial on your own dashboard of doom you're watching most closely. I read every word, and the best insight will get a personal reply and a seat at my next private Q&A. The crash is here. The clearance sale has begun. I'll be shopping. Will you?